Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook. And for today's show, it is Martin Luther King Day. It is the 15th of January. The markets are closed today. So we're going to continue with our education series. We've done a very, layman's approach to the Greeks. Our last episode that we talked about was about the Greek theta, and that was on November 24th. That was episode 55. Prior to that, we talked about gamma, and then we also talked about delta. So we are now on the fourth Greek, which is Vega. And Vega is probably the Rodney Dangerfield of the Greeks, if you will, if you're old enough to know that reference. But it just doesn't get the respect that it deserves as far as the marketplace is concerned. And it's a good time to talk about Vega because we just kicked off earnings season. Last week we had JP Morgan announce earnings. This week we have a plethora of different stocks that will be announcing earnings, but a lot of them in the banks. And we'll actually use one of those examples inside Charles Schwab, who will be announcing on Wednesday in the morning. We'll look at those option contracts and try to discern what Vega can tell us about a potential move after the earnings announcement. Okay, so let's jump right into it. We're going to go to the optionsplaybook.com, which is the book that I authored, and we're going to go to the options basics tab and look at the Meet the Greeks section. Now, here we're seeing the four most important Greeks. We still have a Greek that we need to talk about, and it's fairly important recently. That's called rho, which is about interest rates. So usually rho is usually a non-factor, but recently with the large changes in interest rates that we've had, rho has actually been a fairly big factor. But here we're kind of highlighting that this is Vega, and Vega obviously is not a Greek letter. I think there's many different kind of funny that they just picked Vega to be the volatility Greek. Obviously, it starts with the V. It's really some constellation up in the sky somewhere is probably the most known Vega available. But it's the one Greek that's not a Greek. That's not a Greek letter. But if you see in our little graphic here, Vega's a little tweaked. And rightfully so, because like I said, it doesn't get the respect it deserves. And it's a very important Greek. It tells you a lot about what can happen to your option contract based off of a small move in implied volatility. Just a 1% percentage point move in implied volatility can really affect your option contract. So I'm going to scroll down in this section inside the playbook. And we're going to go down to the definition. We're going to define what Vega is, and then we're going to look at a real option chain and look at some Vegas and look at them relative to the other Greeks inside the chain. So Vega, by definition, textbook definition, is the amount the call and put prices will change in theory for a corresponding 1 point change in implied volatility. And it doesn't take much to change implied volatility by 1 percentage point. So we're going to start. Let's back out here just for a second. You can read a little bit more about all the Greeks in this section inside the options playbook. But let's back out a second here. And we're going to pull up the TradeHawk software. They have real nice option chains inside the TradeHawk software. And we're going to focus on the options grid. And I just set up my chain to address the Greeks. So here we have it. We have inside the options grid, inside the Tradier TradeHawk software, we have, I set up my chains to have delta, gamma, theta, vega, rho, all highlighted. And then we have the theoretical price of an option contract based off of a theoretical pricing calculator. We have implied volatility. Then we have the actual bid and ask. And right now we currently have the markets rocking and rolling. And we see that the SPY is down about 30 cents today, which is the ETF that tracks the S&P 500 index. It's a very, very liquid underlying. And when you're looking at theoreticals and you're talking about the Greeks, if you have very liquid underlines, the Greeks work well. It's that simple. The more accurate the Greeks will, well, the more volume and the more open interest that you have in the option chains, the more they will follow the theoreticals, which we call the Greeks, delta, gamma, theta, vega, rho. So in this option chain here, last week we talked about theta, and you'll notice that theta is a negative number, no matter if you're on the call side or if you're on the put side. And that's basically saying that if you buy option contracts and one day goes away, this is the amount that that option contract can lose based off of 1 day's rate of decay. Now on Vega, they're saying this option contract will lose about 26 cents. And we're on the January 19th expiration. I should highlight that. And we have 7 days until that expiration date. Now, we might go out and look at a 31-day, but we're going to look at the Schwab 7-day one, mainly because they're going to be announcing earnings this week, and we want to take a peek at what Vega can tell us about those earnings. Okay, so let's stay on this expiration. We see implied volatility in the SPY is at 9.6%, and that's highlighted in our option chains here. That's fairly low volatility. Relative, we see that the VIX is trading right around, well, I guess it's probably 13 right now. And that's a 30-day option contract. So if we went out to 30 days, yeah, it's showing here that these option contracts are trading right around 11% implied volatility. So the VIX is probably somewhere right around that 12 level. It's a moving average, which is the volatility index that tracks the implied volatility of a 30-day option in the SPX, which the SPY is based off of. That was a mouthful. All right. With that said, Vega. So right now, the way the options grid addresses it is it's a position Vega. It says that if you buy this option contract and implied volatility moves by 1 percentage point, that this option contract will lose $26. I prefer to look at it as, well, you divide that by 100, it would lose 26 cents. 0.26 is what the Vega would be showing. So that means that if you bought this option contract and implied volatility moved by 1%, which would be a big move considering it's only the implied volatility is only at, let's call it 10% right now. That would be a 10% move in implied volatility. But a 1% move in implied volatility would cost you, if it went up or if it went down, if implied volatility went down 1%, it would cost you 26 cents on your $2.83 option contract. Or if you bought one contract, it would cost you $26. Now, if it went up by 1%, Vega has no regard to direction, you would make $26. And you'll notice that this is also, it's going to be a very similar number if we look over at the puts. So this says 26.51. On the put, it's 26.47. So it does, Vega has no regard to direction. It has no regard to type. It's all about implied volatility. So you have all these different things working in the marketplace. You have the stock going up and down. Then Delta is telling you how much that should move relative to on the stock price movement. And then Delta is so important that it's actually has its own Greek called gamma to show you how much Delta will move when the underlying stock moves. So you get two Greeks based off of the underlying stock. Theta is time decay. Every day that goes by, that option contract is like ice cube melting in the hot sun, right? That time, any time value has to go away. And then we get to Rho or Vega. And Vega is probably one of the more ignored Greeks, but the biggest thing that you need to understand as far as Vega is concerned is it can have a big effect on your option contract, especially if you're trading options around a known news event like earnings. And on top of it, it's going to affect the option contracts that have the most time value. So if we look at the chain, and I'm just going to highlight a couple of things. We're only dealing with a seven-day option contract. 476 is the most at the money strike, and inside the TradeHawk software, we highlight the most at the money strike. We right now have it shaded for in the monies because these are call options, and these are in the money on this side on put options. Okay, so if we're looking at this, we see that the most expensive option contract, as far as Vega is concerned, I should say the largest Vega is the at the money options, right? So right here, 476, the market's at 476.18. We're at 26.46. Let's go 5 points down, 471. Now you are at 18% implied volatility. And if you run up 5 points, we'd be 481. You are at 20% Vega. I'm sorry, I didn't say implied volatility. I meant Vega. At a 20% Vega. So you're talking about 6.06. You're talking about 6 cents on every option contract difference if you're trading at the money options as opposed to in the money or out of the money options. Okay, so why is that? Well, as you go further out of the money, there's less time value for Vega to mess with or implied volatility. As you go deeper in the money, guess what happens? The option becomes more and more intrinsic value, and you have less time value. That means that the bulk of the time value is sitting right on the at the money option contracts. That's where it congregates. And it's the most speculative option contract. It usually gets the most volume, that has the most open interest. But the main reason why the out of the money option contracts have a lower Vega is there's just not as much time premium in them. And that's fairly intuitive. You go deeper in the money on the option contracts, the option prices become more expensive, but volatility or Vega cannot mess with intrinsic value. So as you go deeper in the money, it becomes more and more like the actual stock, like a surrogate for the stock. You get a higher delta. It trades more and more like the stock will it. And because of that, there is less time value in the option contract. And here's one thing that you may not have known is that usually equidistant in and out of the money, you're going to have about the same amount of time value in that deeper in the money option contracts as you will based off of the out of the money option contracts. So everything sits, it's like as far as the curve is concerned, everything sits, the most value is at the money. As we go down a little bit and we get deeper in the money, time value starts to go away. And as we go up, time value starts to go away. And the center is the precipice of the time value. And hence, that's where the Vega sits. All right, so let's jump back out and look at the chain. And I'm just going to show you one thing just to try to highlight this. So by that rationale, this 4760 option contract, right, has a Vega of 26. 0.26 or 26 cents for every 1 point movement in implied volatility. Well, what's going to happen if we go way out in time? Let's go out. Well, let's just move the chart over a little bit here. And let's go out 161 days. Let's go to June 21st of 2024, 161 days. What's going to happen to Vega? Well, there's going to be more time value, right? Because we're going out further in time. And the option is going to go up in price because we're going to go out further in time. And because of that, by that rationale, more time value means more Vega. So if we go out to that June 21st contract, you'll see this move over here. And I'll click on that and we'll stick on that call option. And now we have a real option contract. The at the money option contract is trading, let's call it for 22.50 at the midpoint somewhere. And we are seeing that Vega is now 119. That means a 1% move in implied volatility, our option position would lose or make $119 or 1.19 is what our Vega would mean. That's what our Vega would be. Move the decimal 2 places, and that's the dollar amount that we would lose on the options quote. So long-term options don't get the break from Vega. A lot of people think that Vega really only affects shorter-term options. Vega is actually greater on longer-term options, but it's usually a smaller percentage of the price. But it definitely is worth noting. Longer-term options, implied volatilities don't swing as much. You see a lot more swinging in implied volatility on the nearer term options. And I'm going to highlight that here shortly when we go and look at Charles Schwab. But so here's the moral to the story. Vega's important. Don't ignore it. Realize when it is important. And a lot of times it's around news events. Vega will give you some hint as to how much your option will move to a 1 point movement in implied volatility. The marketplace implied volatility swings can happen very quickly and be very strong, forceful in their moves. So understanding the concept of Vega is very important if you are beginning in option trading and if you're not, right? If you've known option trading for quite some time. How can you offset it? Well, a lot of times if you're announcing around earnings or you're doing trades where you know volatility can move a lot, look at doing a call spread, a long call spread or a long put spread versus just buying that option outright. Why? Because you're buying one option contract that's going to be hurt if implied volatility goes against you. And then you're selling an option contract that will be helped if implied volatility is going with you in that instance, right? Because if it's going against the long option contract, it'll be going with the short option contract because you want that value to go down. So think about spreads. And if I'm trading around earnings, it's very rare that I would do a trade without around earnings, and it would be just an outright buy of a call or an outright buy of a put, because I don't want those issues with implied volatility and the potential that Vega can do to hurt your option contract. All right. So with all that mentioned, let's do a real quick look just because we have the benefit of earnings season kicking off. I'm going to put in Charles Schwab, and according to earningswhispers.com, they will be announcing earnings on Wednesday before the open. Charles Schwab will be announcing earnings. So if we go all the way back to the beginning of the expiration chains, where we started, I'm going to look at the January 19th expiration. And remember, today, well, you're watching this. This is a tape show, but while you were watching this, the markets are closed. So on Tuesday, you'll have a chance to trade Charles Schwab options ahead of earnings. And then on Wednesday morning, they'll announce before the open, and then you will have all the reaction to their earnings once the market opens as far as the options marketplace is concerned. Obviously, the stock market stays open after hours, and there you have it. Okay. So if I look at what does Vega really tell me? I see this option as 152 by 146. And I actually clicked buy and I just put one option contract in here. If I'm buying this option outright, first of all, want to highlight that Vega is the most expensive on the at-the-money option contract, 64.55. We're dealing with live markets. As we go deeper in the money, it gets smaller. As we go further out of the money, it gets smaller. That's simple. Okay. $3.60. That means that if you buy one of these contracts and the implied volatility moves by 1 percentage point, this option contract would lose, this position would lose $3.60. That means the Vega on a normal basis, not on a position basis, would be 0.0360. Okay. Now, I want to make sure that the marketplace agrees with earnings whispers about that implied volatility date, that earnings date. So January 19th, if we look at this awesome grid inside the TradeHawk software, I really love this feature. We see that implied volatility for today, which is January 12th, is 36. Go to the 19th, it jumps up to 46. Go to the 26th, it's 37. And as we go out further and further in time, implied volatility goes back to the normal range for Charles Schwab, which is right around 30% implied volatility. Yeah, if you look historical vol, it shows you that right below is 32 to 33%. Okay, so that's the historical. This is the implied. We are up quite a bit here. So let's say implied volatility goes from 46 down to 30, which is the April. So that's 17 points. If we call it 16 points, I already did the math. If I take 0.0361 and I multiply that by 16, that means that this option contract should lose 57 cents if after earnings, the volatility goes back to a more normal range and you have what's called a volatility crunch. So if I'm buying this option contract, if the market goes up $1, right? If it goes up $1 and I buy this, let's call it 150, it's going to be trading for $1. Let's call it $1.10. If it, if it went up $1, we'd go this way. So we'd be at the 64 strike would be the at the money option contract, or the most one a little bit in the money, and that's trading for $2. So you gain 50 cents on your option contract. About it would go basically the 65 would be trading about where the 64 is at relative to the stock. So if we went up $1, you would expect to make 50 cents about on this option contract just by looking at where the market is at right now. But we have to account for implied volatility. We would lose about 57 cents because of implied volatility. If the numbers just go from 46 down to the more normal numbers, right around 30%, 16% drop, Vega is telling us that we would lose about as much on our bought call option as we would gain from a 1-point movement in the underlying. And that's probably going to happen 99% of the time after earnings. I can't say 100%, but 99% of the time. Implied volatilities come in after that earnings announcement. And if you think about that, how does that all happen? Well, you know, that earnings announcement is like a hurricane being forecasted, and you're trying to buy homeowners insurance down in Florida, waiting for that impending hurricane. And when you're trying to buy it at that moment, and you're trying to buy at these option contracts with a known event that is happening, your insurance contract is going to be very expensive until you find out where that hurricane actually lands and where it hits. And that hurricane here in this example would be the earnings report. A little bit dramatic, but once that earnings report gets announced, a lot of times implied volatilities come in, and that cost goes down quite a bit. Same concept. Okay. So it's nothing to sneeze at, right? And even on the longer term options, this is the January 7th expiration. This is the one that got hit the hardest, right? As far as increase in implied volatility. You're really paying up for this option contract. You might look at it and say, well, that's fairly inexpensive. $1.56 to buy it on the ask. You know, why don't I just buy it? Well, you have to realize that if I buy this option contract, I'm battling implied volatility just as much as I am battling what's going to happen to the price after earnings. It becomes a very similar trade. Okay, so how would I offset it? How would I trade better? Okay, personally, if I was looking at Charles Schwab and I was looking at trading these option contracts, let me go in here and get rid of this for 1 second. Yeah, what I want to do then is straddle the market. If I want to take out that implied volatility risk, I want to buy as much time value as I'm selling, approximately. So if I straddle the market, so let's pull out just for a second here and pull, there we go. Okay, so we're going to pull out for a second here, and I'm getting a little bit long-winded, but if I am looking to do a trade inside the software, there we go. I found it now. Delete. All right. So now I am back to a fresh option chain. Okay. Here's the long spread that I would consider. Let's say I'm bullish. You can do it on the put side of things too, but we've been working with calls, so let's stick with the call side. Not meant to be a recommendation by any means. So if I'm looking to do it, I want to go equidistant in and out of the money, and I'm just going to speculate on price. But what I'm doing is I'm going to be buying as about the same amount of time value as I'm selling. So if we go 3 points down and we buy, and we're not quite right at the money, so it'll be it was right at the money, it would be a better example. But we're about 50 cents off of being right on a strike. So we're going to go down 3 points to the 62s. We're going to buy that. And then we're going to go up 3 points and we're going to sell this. Okay, so now that I'm straddling the market, I'm going to be buying almost as much time premium as I'm selling. So there's going to be a little bit of edge that's going to happen here. But now I'm saying, well, if it goes up above 68, well, I'm great. If it goes down below 62, all right, well, I lost my investment. And it's that simple. It's that straightforward. And I'm now taking out that implied volatility issue that you have to deal with around earnings. So if I'm trading something and I want to speculate on that earnings price, I would look at either doing it this way with a long call spread or go to the other side and do the long put spread if I want to be bearish. But I want to go equidistant in and equidistant out of the money. And then I'm dealing only with the actual movement of the underlying stock. I mean, I still got some issues, right? I still got some little bit of time decay on the option contracts, and it's still not exactly like trading the stock. But you take that big component of that implied volatility crunch, and you make it you make it a non-factor relative. Well, not 100% non-factor, but you take away a lot of that risk overall. All right, that's it for this episode of Options Guide TV. I hope you have a great week, and we'll see you this coming up Wednesday for the next edition at 11 a.m. Eastern Time. Thanks for coming, everyone.